Good morning, everyone. Welcome back to my channel. Today I'm going to be discussing how you should be thinking about your money after you invest into the stock market. A lot of people, especially those in my age group, they want to use the stock market as a way to make a quick buck and do a little gambling and use the stocks that they see in the headlines in newspapers, or let's say Bloomberg.com or CNN Business and stuff like that. They want to jump on board because they think they're going to get a quick return out of their stock market investment. Well, the quick return situation, I wouldn't even consider it an investment. It's more of a trading, it's more of a gambling, and those kinds of situations are not necessarily good for everyone, and I wouldn't recommend it. I wouldn't do it, but it's your money. You can do whatever you want. I'm not a financial advisor. But your mentality when it comes to your money, once you invest your stock market, should be in a way where you think about it in the long term. In the accounting terms, long term is 12 months and more or longer, but you shouldn't be thinking about it in 12 months. As a matter of fact, you should be thinking about long-term investments as 5 to 10 years. And once you put your money into a stock or into the stock market in general, you should consider that money gone. So that means you should be using the money that you don't need for the next 5 to 10 years. So if you're thinking about buying a house and you need that money for a down payment, do not invest it into the stock market. Because let's say 5 years from now, or even let's say 3 years from now, you want to buy a house and you want to put a down payment of $10,000. That $10,000 was originally invested into the stock market. 3 years from now, the situation in the markets is in a way where your $10,000 is actually $7,000 because stocks fluctuate. The risk in the stock market is that your money fluctuates. Doesn't necessarily mean that it will stay at 7,000. Doesn't necessarily mean that it will go up to 20,000. We don't know these things, but assume that 3 years from now your money's at 7,000. You want to invest into the stock, or you want to buy a house. You cash in your stocks. You lose $3,000, and you're left worse off. And you would have been better off if you just left the money under your mattress. So if you think you're going to buy a house or make a big purchase in the next less than 5 years, for example, do not invest in the stock market. So the way you should be thinking about your money once it's put into the portfolio is that it's gone. Do not think about your money when it's in the stock market. Just let it grow. Just let it sit there, come back 5 to 10 years from now and look at it. Obviously, keep a mental note of the money and check back on it, but do not fixate on the returns. Do not think you're going to get rich quick. Do not think you're going to make a lot of money in a short amount of time. You're going to make a very small amount of money, and if you hit it big, I can guarantee you that the human greed is in a way where, let's say if you make a 50% return and you have such a good bet on one stock and you make 50%, well, why would you cash it if you've made 50%? If you've made 50%, that means you can make 75, 100%, 150, right? It's going to keep going up. So the human greed is going to make you think that way. And once it crashes, you freak out. You're like, oh my God, I had 50% in gains. Now I'm down. I lost not only the 50%, but my principal is lower than it was in the beginning. And you freak out. You're like, okay, might as well just cut the losses short. You sell at the bottom, you lose money, and it's just a terrible situation. Do not act this way. Think about your money in a way where it's gone once you invest it. Put it in a stock or in an index that is reliable. So if you want to invest in an index fund, you invest in a broad market. And I'm sorry for the jargon, but I'm going to keep it very simple. The index fund is a group or a basket of stocks that represent an economy or a market. The S&P 500 index represents the broad US market, but it's not necessarily a good gauge for the overall market. It's for the 500 biggest companies in the country, the 500 Fortune 500 companies. Although it's not a good gauge of the overall broad market, it's a pretty damn good gauge for the overall market, because these are the 500 biggest companies. And if they're not doing well, the overall market is not doing well. If they're doing well, well that's good, because you're invested in the index fund. If you're investing in individual stocks, this is the riskiest way to invest. So you should really know what you're doing, and you should use intuition on top of research and on top of just disciplined behavior when it comes to investments. Let's say you could either invest $1,000 into the Apple stock, or you could invest in X, Y, and Z, which is a 2-year-old company out of China. It's a startup, makes coffee, for example, and is trying to rapidly expand. Well, the problem with a 2-year-old startup company in China selling coffee is that it's 2 years old. You don't know too much about it. You don't really know about the financials. We don't even know if the financials are true. This is China we're talking about. And then these companies have not weathered a recession before. So if a company is 2 years old, they didn't go through the 2008 crash. They didn't go through the stock market slowdown or the economic slowdown in 2015 in China. We don't know how they're going to weather the stock market. We don't know how the company is going to react when there's a downturn. We don't know how the customers are going to react to the goods that they're selling. We don't know these things. So without any historical evidence, we don't really know how good of a company this really is, this X, Y, and Z. Whereas Apple, they've weathered multiple recessions and they've only come out stronger than before, because Apple is not necessarily based off of trends. Apple's based off of long-term innovations that they plan 10 years in advance and they release when the product is ready. And there is usually a demand for those products, whether there is market research or not on that, because Apple releases their products in a way where you didn't even know you needed it, but now that's out, it works so well that you need it. You have to buy it. So it's less cyclical. So if the market crashes, Apple will still sell iPhones. Apple will still sell Apple Watches. Even if they don't sell these physical hardware products, they still have services. They have recurring revenue that they get from the App Store, they get from Apple Care, from loyalties that they get from Google, all these different revenue streams that Apple has. Again, whereas X, Y, and Z, they only have one revenue stream, which is the customer going to the store, buying coffee in China. So please do your research before investing into the stock market. Please think long term. Do not be a trader. If you're good at it, do it by all means. But for the average person, do not try to be a trader. Try to be an investor. And try to find value and try to use your intuition to see if these companies are actually good companies. Don't look at the stock as a game. Don't look at it as a bucket you can just pour your money in and it'll grow no matter what. That's not how the stock market works, because the stocks are a representation of the value of the company. So if you really think the value of the company is going to exponentially grow just because they're opening stores to sell coffee in China, that might work. But again, if there's a slowdown, your money's gonna crash, or your money's gonna go low, very low. But with let's say the Apple stock, it could go down, but there's almost a guarantee that it will come back to where it was, break even, and further and beyond. So do research. Don't make really weird decisions off of headlines or articles. Do your own research. Look at financial statements. Think long term. Once you put your money in the stock, consider it gone. Just think of it as burning your money. You don't have it anymore. You just do not have that money anymore for 5 to 10 years. Once you come back 5 to 10 years from now, you will thank me. I don't know. But thank you so much for stopping by. I'm going to enjoy my coffee. It's 7 in the morning. It's an early start for me when it comes to making videos and doing things. I really hope you appreciated this video. Leave a comment down below. Like this video. It always helps me. I'm very new to this, so I'm just learning. I'm just learning everything, and I'm hoping to share my knowledge with you guys and just have a conversation, just heart to heart, so you really know that this is not that hard. It's basically just intuition, discipline, research, and that discipline also goes with patience and not having the itch to make a quick buck, but a very solid, sustainable, long-term investment. Anyways, thank you.